Thank you for attending this Quantitative Disclosure Summary presentation. I am Kawai in JSCC's Clearing Planning Department, and I will be leading today's call. Today's meeting will be around 30 minutes, starting with an overview of this quarter, followed by the topic of this quarter, and then a briefing on the major risk points. Finally, we will try to address as many of your questions as possible within the schedule. On this webinar, as a special topic for this quarter, we will present an introduction to JSCC's new margin calculation methodology for listed derivatives, which changed from span to bar. All of the meeting attendees will be on mute, but if you have any questions, please let us know using the Webex Q&A function. To begin with, Mr. Miyauchi, JSCC's CRO, will give an overview of the quantitative disclosures from the fourth quarter of 2023.
Thank you. JSCC keeps 71 billion yen of skin in the game, which is same as the previous quarter, mostly from JSCC own capital, but it also includes contributions from affiliated exchanges. On aggregate, these were equal to 79% of JSCC shareholder equity. During this quarter, stress test breaches, where the risk amount in extreme but plausible market conditions exceeded pre-funded resources, were observed on 3 days for cash security clearing service. All of the breaches were resolved on the next business day through the requirement for additional collateral. As for margin backtesting, for the past 12 months, the cover ratio was comfortably within JSCC's targets, 99.5% for IRS and CDS, and 99% for other products. There were neither liquidity stress breach testing breaches nor any participant defaults during this quarter. JSCC experienced no suspension of the clearing service due to system failure or for any other reasons during the past 12-month period. In this quarter, JSCC has changed its margin calculation methodology from span method to bar method, which will be explained on the next page. Now I will pass back to Ms. Kawai.
Thank you. Page 7 is the topic of this quarter. Listed derivatives margin migrated to bar method. In November 2023, JSCC shifted its margin calculation method for listed derivatives transactions from span to bar. The new bar method uses multiple historical data to suppress sudden changes in margin and enhance transparency. In addition, a portfolio-level risk calculation enables more sophisticated risk management, including optimization of margin. As you can see the table below, under bar margin calculation method, there are two types of calculation method, i.e. historical simulation method, called HS bar method, and alternative simulation method, called AS bar method. Under the HS bar method applied to most of the products, the portfolio profit and loss is obtained according to each of the scenarios generated based on historical market data and other factors, and then the amount to cover 99% of such profit and loss is obtained. Under the AS bar method, parameters such as expected price fluctuations are set in advance, and the portfolio profit and loss is obtained according to the scenarios generated based these parameters. To ensure a smooth transition to VaR, JSCC applied transitional measures such as applying the AS VaR method, which is an exceptional method to commodity derivatives excluding electricity and LNG. Page 8 shows the graph of changes in VaR margins and the leverage ratios for large contracts of Nikkei 225 futures trading from January 2022 to March 2024. As can be seen, after the introduction of VaR, the margin per contract has been at a level of over 2 billion yen. But this was mainly due to a rise in the underlying asset. As for the leverage ratio, it has remained stable at around 20 times. We will continue to monitor this in the future. Now, back to the PQD. Page 9 is an introduction of JSCC's service structure. Clearing services are divided into 14 categories according to the governing regulations and product features, with each maintaining its own default funds. Please note that in this presentation, some data is presented across multiple categories as the resources may be shared. Page 10 shows financial resources for participant default called skin in the game or SIG, and contributions from relevant exchanges and PTSs. Most of the exchange contribution is from entities in the same corporate group as JSCC, namely TSE, OSE, and TOCOM. As shown in the left-hand table, JSCC's skin in the game for ETP non-commodity was 20 billion yen, which is shared by all of the relevant clearing categories. The right-hand table shows compensation by exchanges and PTSs. And for stress testing, the sufficiency of the financial resources for each category was tested by prorating these shared sources according to the relevant default fund amount for each category. Page 11 shows the ratio of skin in the game to JSCC's capital. The left-hand graph shows the skin in the game to be used before the mutualized default fund or DF, and the right-hand graph shows the skin in the game to be used before the default fund plus alongside default fund of defaulting participants on a pro rata basis. Skin in the game before default fund on the left ranges from 18 to 50% of shareholder equity, and skin in the game before and alongside default fund on the right is from 34 to 99% of shareholder equity. So JSCC contributes relatively large amounts of shareholder equity to skin in the game compared to other major CCPs, which shows our strong commitment to risk management. Page 12 shows the required default fund, which covers any default-related losses that would be mutualized among non-defaulting participants. The graph on this page shows the ratio of skin in the game and the contributions from exchanges to default fund from members. The increase in default fund for ETP non-commodity was due to rising stock prices. On page 13, the data is listed for these graphs and the amount of potential assessment, or so-called cash call, is also provided. As stated in the footnote, the cash call for any ETD is capped at 3 times the default fund requirement, and for OTC products, it is capped at 1 time the default fund requirement. Moving to stress testing, page 15 shows the largest value and mean value of the SLOIM, which is the stress risk amount exceeding initial margin deposited including add-ons. Please note that due to the PFMI quantitative disclosure definitions, the default fund on page 12 is the value at the end of the quarter, but the SLOIM on page 15 is the largest or mean value during the past 12 months period. JSCC's default assumption is covered too, except for any listed commodity derivatives other than OSE Petroleum, which is the largest one plus the 5 smallest firms in the net asset. Among all clearing service categories, ETP index futures options had the largest volume, with a peak value of 440 billion yen. Slowing for OTC JGB decreased from beginning of 2023. This was due to the largest historical slowing values gradually falling out of the 12-month scope. Page 16 shows the number of days there was a shortfall in the stress testing of pre-funded resources and the largest shortfall. Breaches were observed on 3 days for cash securities. But these breaches were mainly due to the expansion of positions by the largest participants, and all were resolved on the next business day through the requirement of additional collateral. Page 17 shows the required and excess initial margin amounts. The dark blue is the house initial margin requirements, and dark orange shows clients. Light blue is the excess margin for house accounts, and light orange shows client accounts. The required amount of OSE listed ETP, IRS, and OTC JGB were the largest at between 1.5 to 2.9 trillion yen. Looking at the breakdown between house and clients, OSE listed ETP was driven mostly by clients. IRS was evenly split between house and clients, and OTC JGB was mostly house. This trend has remained unchanged for quite a long time. Moreover, the client's excess margin held was quite large in OSE listed ETP and IRS, which has also not changed significantly. The data used for the graph on page 17 is shown on page 18 and 19. Now, page 20 shows the number of breaches in IM backtesting for the past 12 months period. The decrease in the number of margin breaches in ETP, JGB futures and options OSE was because the December 2022 breach, caused by the Bank of Japan's monetary policy meeting, are no longer included in the period covered. The increase in ETP index futures and options OSE was due to the market decline at the beginning of October, while the increase in the number of breaches in ETP commodity futures was due to market fluctuations. The upper chart on page 21 shows the largest breaches in the past 12 months, which were about 18 billion yen for IRS and 62 billion yen for OTC JGB. This test only looks at the base IM requirement without add-ons. JSCC has confirmed that these breaches would have been recovered by resources such as IM add-ons, excess IM deposit, or skin in the game, and the whole amount of the default fund would have remained almost untouched. The lower chart of this page shows the largest breaches in the past 3 months. The upper chart on page 22 shows the quarterly largest value of variation margin, or VM, paid to JSCC, and the lower chart shows the largest value of IM gold during each quarter. Please note that while VM needs to be deposited and settled in cash, IM may be deposited in cash as well as various securities and other instruments, giving our participants some flexibility for funding. Page 23 and 24 show the composition of collateral used for IM deposit. On page 23, you can see that the majority of ETP IM was cash, as shown in dark blue and dark orange, but some was in JGB and stocks shown in gray and yellow. Cash collateral was held at either the central bank or at selected commercial banks. The secured cash deposited at commercial banks, in dark orange, was held in settled account of commercial banks, which were fully covered by the Japanese Deposit Insurance Scheme. On page 24, you can see that the majority of OTC IM was deposited in cash, but with some JGBs. Deposit of stocks are not allowed for these OTC categories. The entire amount of cash collateral for OTC JGB was held in the central bank, and for CDS and IRS, the participants or customers may select their custodian for cash collateral, i.e. Japanese trust account, or the central bank account in the name of JSCC. The secured cash deposited at commercial banks in dark orange for CDS and IRS was held in such trust account, which is legally protected from the bankruptcy of JSCC as well as the participant. Page 25 separates cash deposits into those for initial margin and default fund. We are holding a total of about 9.2 trillion yen of cash collateral across all the categories. Next, page 26 shows the custodians for this cash collateral, with almost 100% held in either the central bank account, settlement accounts covered by deposit insurance, or the trust account. Page 27 covers liquidity risk management. Please note JSCC's liquidity risk appetite is cover 2, but this data is presented based on cover 1, in accordance with the PQD guidance. And while JSCC separately calculates and manages default funds by category for liquidity risk, JSCC calculates and manages it across categories. However, for OTC JGB, JSCC has established a separate liquidity framework using repo with clearing participants, because the transactions under this category involve large amounts of principal settlement. In the chart, you can see that the liquidity financial resources significantly exceed the required amount, and no breaches were reported in the liquidity stress testing. At the time of a participant default, at least a half portion of non-cash collateral could be liquidated and applied to the settlement with survivors. However, in this data, non-cash collateral is not deducted either from JSCC's payment obligation of the estimated payment or the actual payment, because to be conservative, we consider that it could be difficult to swiftly liquidate such collateral on the date of default. So we do not regard such collateral as available liquidity resources. Page 28 shows the liquidity resources for the categories other than OTC JGB. The resources reported as cash at the central bank on the first line and secured cash at commercial banks on the third line include cash in the DF related to ETP, where at least 50% of the required DF minus 1 billion yen must be in cash. The unsecured cash on the fourth line shows JSCC's own funds available for use as liquid financial resources following a participant default. The unsecured committed line of credit on the sixth line shows the committed liquidity available for JSCC's parent company and multiple commercial banks that have been designated as fund settlement banks and total to more than 1.5 trillion yen. Now, we will move on to Q&A. If you have any additional questions, please let us know using Q&A function. Okay, well, we received a question in advance. The first one is, will you be revisiting the static amounts of CCP skin in the game? Thank you for your question. JSCC has reviewed the adequacy of skin in the game annually, and we plan to increase its loss compensation funding of OTC JGB by May this year. Other products will continue to be reviewed. And we received a question from Q&A box. Let me pass this question to Mr. Nakaji,
Okay.
please.
Okay. Thank you. The first question is about please ask how determine margin calls the higher of HS bar or AS bar. Sorry for giving confusion from our explanation. Actually, HS bar is used for the financial derivatives, such as Nikkei 225 futures or JGB futures. On the other hand, AS bar method is used for only for the commodity derivatives, such as gold futures or Dubai oil futures, excluding electricity futures and energy futures. So HS method and AS method are not used for same product at the same time. The reason for using this kind of exceptional measures, such as AS method, is due to the members' request or the character of the product. But the risk amount for those commodity products is very, very limited. So we are comfortable using this kind of exceptional method for these products. And the second question is about the BOJ's action. So the question is, what is the expected impact of a potential removal of the yield curve control? Do you think it will lead to increase in margins? Thank you for the question. It's very, I think, a timely question. So actually, we have estimated the impact of the possible change of the BOJ's rate policy. So if BOJ, if the market fluctuation, which was happened in December 2022, was happened again this week, of course, the margin would increase to some extent. But as you know, the impact of the volatility could be different from that of the 2022. So it is not possible to expect in advance precisely how much margin increased in advance.
Thank you very much for your time. We are very much committed to the transparency, and obviously, Bank of Japan is having a policy meeting in this week. So we are very committed to provide the transparency, including, as Nakajima mentioned, that we are providing some simulated data on the possible margin increase after the policy meeting. So if you have any questions, please just let us know, contact to our team. And we are very much committed to provide as much information as possible to you. So thank you very much.
Well, thank you, Otashiro-san. Well, with that, I'd like to wrap up today's webinar. Please do not hesitate to contact us if you have any additional questions after the call. Just for your information, you can find today's material, recording of past webinar, as well as the minutes of QA sessions at the same page of PQD data on our website. So please visit our website if you're interested. Thank you for your time again. We look forward to posting next webinar and speak to you soon. Thank you.